In recent months, concerns about the U.S. economy have quietly begun to build. A mix of slower job growth, persistent inflation, and mounting political pressure is reviving a familiar word in economic discourse: stimulus. It's a term that, for many Americans, stirs memories of pandemic-era checks and emergency relief. But today, the conversation is evolving, focusing not just on direct aid, but on interest rate changes, financial policy shifts, and what the Federal Reserve might do next. So, let's break it down. What's happening with the economy, why it matters to you, and what might be coming. The alarming jobs report, a signal of slowing momentum. At the center of this economic discussion is the latest employment data. ADP, the private payroll processing firm, released its May jobs report, and the numbers fell well short of expectations. Economists had predicted that 110,000 new private sector jobs would be added. The reality? Just 37,000. That's not just a miss. It's the weakest monthly hiring pace in over 2 years. When job creation slows down this sharply, it raises red flags for economists and policymakers alike. Job growth is often viewed as a reliable indicator of overall economic strength. If employers are hiring, it typically means they expect consumer demand to hold strong. But when hiring slows, it can mean companies are pulling back, concerned about future sales, rising costs, or uncertain policy decisions. The May report didn't just show a general slowdown, it painted a picture of an economy under stress in specific areas. Sector by sector, who's hiring and who's not. The decline in job growth wasn't evenly distributed. Some sectors took a noticeable hit, while others showed small signs of resilience. Goods-producing industries. These include mining, manufacturing, and construction, sectors often tied closely to infrastructure, global trade, and industrial demand. Mining and manufacturing saw net job losses. Construction managed to eke out a small gain, but not enough to offset broader declines. Service sectors. Traditionally more stable during downturns, these industries also showed signs of weakening. Business services, education, and trade all reported job losses. This is especially concerning because services make up a huge portion of the U.S. economy. Bright spots. There were a couple of exceptions. Leisure and hospitality, which includes jobs in hotels, restaurants, and entertainment venues, added 38,000 positions. Financial activities, banks, insurance, real estate, added another 20,000. But even these gains weren't enough to balance out the broader slowdown. Company size matters. Small businesses, which are often considered the backbone of local economies, shed 13,000 jobs. Large companies lost around 3,000. The only group with notable growth was mid-size firms. This imbalance underscores an uneven recovery that could strain certain communities more than others. Wages still growing, for now. Despite the hiring slowdown, wages continued to show strength in May. Workers who remained in their jobs saw a 4.5% year-over-year wage increase, while those who switched roles got an average raise of 7%. This suggests that the labor market, while cooling, isn't collapsing. But wage growth is often a lagging indicator. If hiring continues to shrink, upward pressure on wages could fade. Companies may start to pull back on raises or bonuses, and that could ripple through household budgets, especially for families already feeling squeezed by high prices. Trump turns up the heat on the Fed. The weak jobs report set off a wave of political and market reactions, most notably from former President Donald Trump. Known for his aggressive posture on economic policy, Trump wasted no time in criticizing Federal Reserve Chair Jerome Powell, calling him "too late, Powell," and demanding immediate interest rate cuts. Trump pointed to Europe's more aggressive approach, highlighting that the European Central Bank has already slashed rates multiple times. He argued that the U.S. is falling behind in supporting its economy and that the Fed's inaction is risking long-term competitiveness. This kind of public pressure isn't new, but it adds intensity to the conversation, especially in an election year. While the Fed maintains independence from political influence, it also cannot ignore market expectations and economic realities. Why interest rates matter so much? At the heart of this debate is the federal interest rate, which currently sits between 4.25% and 4.5%. That's relatively high, especially compared to recent years, and it affects virtually every part of the economy. Your mortgage and loans. Higher interest rates mean more expensive borrowing costs for homes, cars, credit cards, and even student loans. Lower rates could ease some of that pressure, making big purchases more affordable. Business investment. When money is cheap to borrow, companies are more likely to invest in growth, opening new locations, hiring more staff, or upgrading equipment. When borrowing is expensive, expansion plans slow down. Savings accounts. On the flip side, higher interest rates typically mean better returns on savings and CDs. Cutting rates might help borrowers, but it could reduce income for savers, particularly older Americans living on fixed incomes. The Fed has so far held off on cutting rates, saying they're waiting for more data to ensure inflation is truly under control. But the latest job numbers and pressure from the political class are pushing them toward action. The odds of a rate cut are rising. Markets reacted immediately to the ADP report and Trump's comments. Before the jobs data was released, traders placed the odds of a July rate cut at 24%. Just one day later, that jumped to 30%. Now, analysts believe there's a 78% chance of 2 rate cuts before the end of the year. Why does this matter? Because financial markets start adjusting based on those expectations. Bond yields change, mortgage rates shift, and business plans adapt. Even if the Fed hasn't officially moved, the anticipation of a move creates its own ripple effects. Could broader stimulus be next? Lowering interest rates is one form of stimulus. It's meant to make borrowing cheaper, encourage investment, and stimulate demand. But if rate cuts don't do enough, policymakers may begin considering additional measures. Here are a few possibilities. Infrastructure spending. Projects like roads, bridges, broadband, and energy upgrades not only improve national assets, but also create jobs quickly, particularly in construction and engineering. Targeted tax relief. The government could offer temporary tax cuts or credits to certain groups, like low and middle-income families or small businesses hit hardest by inflation. Small business support. Expanded lending programs, grants, or credit guarantees could help stabilize local economies and protect jobs. Direct financial aid. While controversial, direct payments, such as stimulus checks, have been used during economic crises. Whether such an option returns depends on how deeply consumer demand falls and how politically urgent the situation becomes. Tensions. Behind closed doors, behind all this is an increasingly tense relationship between the White House and the Federal Reserve. Trump has privately pushed Powell to act faster, arguing that other global powers are already taking steps to protect their economies. Publicly, Powell has remained firm. The Fed will act based on hard data, not political pressure. This standoff matters. The Fed is designed to be independent for a reason, so it can make sound, long-term decisions without short-term political interference. But in practice, public pressure from presidents, especially during times of economic stress, can influence the timing and tone of Fed announcements. What this means for you. and how to prepare. So, what should everyday Americans make of all this? It's easy to feel overwhelmed, but this is exactly the kind of moment where being informed makes a difference. Here are a few steps to consider. 1. Check your financial cushion. With uncertainty ahead, having a few months of emergency savings is more important than ever. Even small contributions now can help build a safety net. 2. Be cautious with big purchases. Interest rates could change soon, but timing those shifts is tricky. If you're planning to buy a house, a car, or make a large investment, pay close attention to how rates evolve in the coming months. 3. Review your credit and loans. Understand how your existing debt might be affected by rate changes. Variable rate loans, in particular, could become cheaper or more expensive, depending on what the Fed does. 4. Stay informed without panicking. Economic shifts don't happen overnight. Watching job data, inflation reports, and Fed statements can help you plan smarter. Avoid knee-jerk decisions. A moment of watchful waiting. While we're not in a full-blown crisis, the signs of a slowdown are becoming clearer. The May jobs report was a wake-up call. Political pressure is building. Market expectations are shifting. And the debate over stimulus, what kind, how much, and when, has officially returned to center stage. Whether or not the Fed cuts rates in July, or whether more dramatic policy tools are rolled out, depends on how the next few months play out. For now, staying steady, informed, and financially aware is the best strategy.